From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, October 18th, and you're listening to the HPS Insight Macrocast. Tony Fratto. I'm here in DC headquarters for the first time in a few weeks. It's great to be here. John Fagan and Brendan Walsh from Markets Policy Partners. We have a special guest with us this morning. It's the IMF World Bank annual meetings, and my old friend Ahmed Saeed, now the Vice President of Operations over at the Asian Development Bank, is with us today. The IMF World Bank annual meetings every October this week, in addition to destroying traffic in downtown DC and filling up every hotel room, is an occasion for lots of discussion about the global economy, regional economy, development, opportunities for financing growth all around the world. And
it's perfect time for it.
Yeah.
Lot to talk about.
To talk about, and a lot going on in the global economy, especially from the Asia perspective. Ahmed, welcome.
Thank you, Tony. Great to be here.
What are you? What's the view from Asia right now? I mean, so if you don't know, the Asian Development Bank based in Manila in the Philippines, you have a view on what's happening, how the U.S.-China trade war is impacting things. What's the view from Asia right now?
Well, I think there's definitely a lot of concern about a global slowdown beginning with developed markets, and I think we just saw the China numbers come out yesterday. 6%, which I think sort of surprised people on the downside. The interesting thing I would say is, one of the silver linings for Asia is actually something that's probably very negative for the rest of the world, which is the trade war. So to the extent we're seeing some positive news in certain countries in Asia, it's really coming from sort of redirection of investment.
Interesting, yeah.
So you see a country like Vietnam, for example, is certainly benefiting to a certain extent. Even places like Singapore for some of the higher valuated.
Even I'll tell you, it was in Taiwan not too long ago. In Taiwan, talked about numbers like $20 billion this year of FDI coming from mainland to Taiwan. So that was pretty interesting.
Yeah, so there's definitely that dynamic, which is obviously a sort of countervailing force. But more generally, we've seen as an institution, we've really seen a slowdown across emerging Asia. So we lowered our growth forecasts for APAC Emerging Asia from 5.9 to 5.4% for this year. And that's really broad-based. I mean, you see that in sort of the larger economies like China. You see it in sort of Southeast Asia, middle-income countries, whether it's Vietnam or Thailand. And you even see it sort of stretching out amongst our sort of smaller island economies, some of our much smaller and more vulnerable economies that we track. So I think that's something definitely for concern. There's some other things that we're really focused on that start to become important in environments like this, which is really things like debt. And I think there's always a lot of focus on sovereign debt post Asian financial crisis. But a bit of the story that I don't think people have focused on enough, although they certainly have talked about it, is the real jump in private sector borrowing.
Great point. Yeah.
Across Asia, which is probably the real vulnerability that we need to be focused on. And, unlike developed markets where you've probably seen, the shift of liabilities from the private sector to the sovereign sector over the last 10 years, in Asia, you've seen banks, financial sector, corporate sector, really an explosion of foreign currency liabilities. And that's something I think that we've really got to keep an eye on.
Interesting. And overwhelmingly, which currencies overwhelmingly?
Well, I think the foreign currency liabilities are primarily dollar.
Right.
Yeah, there's a little bit of RMB, but no, not by any great stretch of the imagination. I think that's something that we should all keep an eye on because it can really become a problem if the macro environment deteriorates significantly or the rate environment changes substantially.
Is that increase in debt concentrated in any particular sector, or is it really broadly based?
I mean, I think the banks, but no, it's pretty broadly based across, across corporates in these regions. The banks, obviously, you've always got to keep an eye on, so they're important, but it's pretty broad based from what we see.
If we think about the countries that have, you mentioned, Vietnam as, and I think people have focused on Vietnam as sort of if there's a winner in the trade war, it's probably been Vietnam. Are there any others?
Yeah, I think the benefits are widely spread, although unequally shared is probably the best way to describe it. So I was in Singapore a few weeks ago, and a senior government official commented that, they too had seen some benefit, but in their case it was really coming in the higher value-added segments, whereas perhaps in a country like Vietnam, it's a bit more sort of in the middle value-added segments. So I think that, it's pretty broad spread, actually, but some places clearly have benefited more than others.
Yeah.
I'd be interested in both your takes on it. But, so we have a trade war and it's tariffs and things like that. But a couple of weeks ago, they kind of threw out and then immediately backed away from it, talking about using financial flows as part of this trade war. Well, I don't think they're going to do the nuclear option. There's ways to kind of like cut off investments.
The nuclear option being like ordering U.S. institutions not to.
But do you think that this is something? Is this something you're concerned about that will kind of make it more difficult, especially in China, for U.S. investors to buy both equities and debt?
No, I think liberalization of trade regimes was a great driver of growth, but liberalization of financial systems was also an extraordinary driver of growth, right? So, to the extent that we this retraction of, liberal economic world order moves from trade to the financial system, it's going to have a really negative impact on growth.
Yep.
And I think I saw, Tony, you had a tweet not too long ago. You were talking about, I think, 3% growth, and you had this comment.
Yeah.
That feels okay to America, but, come to a Cambodia.
Yeah.
Right? And it's got a real human impact. So I think the consequences of these things for emerging economies and for individual people's lives, they're real.
Yeah.
Yeah, we want to see those flows. I mean, that's. Ideally, you'd love to see, labor and capital and trade and services all moving where there can be, create the greatest value and generate growth. And we know that that's it's most efficient and it's the most way to.
But I think it's a great point where a tariff can affect a specific industry like a farmer, things like that. But it's not necessarily broad based. But if you restrict complete flows of capital, that seeps down to the lowest level. It actually affects immediately the lowest levels.
And the other thing I would say is that I was speaking with one of the senior guys at the IMF, and they had obviously they revised downward their World Economic Outlook forecast, and I said, well, and he said trade. I said, well, what's really driving this? Is it trade or sentiment? And he said, look, it's really sentiment. The raw numbers are trade aren't large. I think the sentiment on financial sector sanctions type activity or retrenchment, actually, I think the sentiment impact is potentially quite larger than the sentiment impact on trade. So if the primary driver is really coming from expectations as opposed to through the real sector, then I think this is a potentially more significant set of actions in terms of their implications more broadly and deeply for countries.
That's stuff I definitely want to get into. I am going to want to get into some of the things that you're doing at AFDB, but this on this sentiment question and on trade and the impact it's having, what the long-term impact is. We talk about winners, right? But moving supply chain operations is not a little thing. That's a big thing,
absolutely.
Right? It's like it takes time, and I think it could be sort of overstated how much of that can happen. But and by the way, the trade war could end tomorrow, right? Maybe not, probably not. But in 6 months, it could.
Yeah.
Especially people could say, "Well, that doesn't work. That's been really damaging. We're going to continue to talk, but these tariffs are a mess. Let's take them off."
Well, it could end. Stephen Moore was in the news today advising Trump that the trade war is hurting.
Right.
He might listen to it and just end it.
Yeah. So this isn't like it doesn't necessarily mean that. If it's tariffs that are causing people to think about investment in different economies, the tariffs could come off as quickly as they've come on, right? It's not impossible. That's not it's not my base case. It's not what I'm betting.
But it's a good point.
But it could happen if you're a firm out there, and so this is where I think it crosses over into sentiment. What do you not just choosing where you might relocate sourcing, but whether to, how long do you sit around and wait and try to figure out is it worth it? Is it worth it to just deal with the tariffs and maybe continued friction, or do we go and make this jump because it's a big decision? And so in terms of its hit on growth, how much of it is is it a business investment driven also, which I think we've seen even in the United States. We've seen a pretty sharp fall off on business investment that I think you can point to trade war. Yeah. Well,
Yeah.
so we'll have to see, on that.
But I'm also curious. You mentioned Singapore. So with the situation in Hong Kong, it's difficult to move a factory, but a financial institution or investment fund can pick up. In a day.
You certainly.
Are you seeing that yet?
No, I mean, I'm certainly not seeing it, but you're certainly seeing people make that comment.
Yeah.
Right? And you hear this comment from people who live in Singapore. You hear it from people who live in Hong Kong. So people are certainly,
It's on the radar.
Yeah, it's on the radar.
Okay, can we talk about what you're seeing from just from Asian Development Bank and some of the things that y'all are doing? I mean, I heard a discussion yesterday about over at Center for Global Development, our friends over there, with a good discussion. The president was there, discussing things like graduation.
Yep.
Great, for country, whether countries ought to be receiving concessional lending and maybe some innovation in financing. How do you think we should think about that? It's something President Trump actually has raised and as a concern. I think it has issues for financing of our MDBs.
Yeah, well, I think you'll hear a lot of people say these institutions were set up to help poor countries. As countries become wealthier, the institutions should scale down their lending and certainly their concessional lending. And I think that's a great point. I would argue, however, that MDBs like the Asian Development Bank, the African Development Bank, and others, these are totally unique actors in the international economic ecosystem. Not only are they totally unique because of their balance sheets, because of their shareholding, because of their institutional legitimacy, their expertise, they're also totally unique because the time in geopolitical and geoeconomic history that allowed them to be created is gone, and it's not coming back. And so I think that there are a whole host of problems for very poor countries, for countries exposed to climate change, but also I would argue for middle-income countries, for which these are really well-positioned actors for addressing these problems. So take a place like Vietnam. Got a whole host of middle-income country-type problems. One of the big problems they've got is they've had a huge amount of FDI. It's supported growth, but they, as an economy, haven't really integrated into global value chains successfully. So you've got a lot of imports. They get reprocessed. They get sent out. Local companies haven't stepped up. Now, why is that? To a certain extent, it's because they really don't have that robust middle sector of economies. They've got very small businesses. They've got very large businesses. How do you foster the creation of that space? Well, it's a really complicated problem. You've got to chip away at it over a number of years, and the government needs allies. So, should ADB's lending in Vietnam, for example, pivot from SME lending to more medium to medium-large, because that's where we're going to see the productivity gains for the underlying workers? Are there things that we can push them to do on the regulatory side? So I think that these sorts of problems, which I would describe broadly as middle-income trap problems, they're one example of the sort of things where I think it is in the interests of all of the various actors around the world, and certainly the shareholders of the ADB, to say we want you to do that. There are other problems which are really global public good type problems, like climate change, where you really need some actor where everybody's represented because nobody can do it on their own. So I would certainly argue, without getting into the specific question of when and how a country should graduate, which people get very excited about, as you know, Tony, I would just generally argue that it's in everybody's interest to use this unbelievably powerful tool for some really, really complicated problems.
I couldn't agree more. Yeah, and I'm glad you had the chance to join us this morning. We were able to capture you for 10 minutes this morning. Always
great to see you, Tony, and I'm really, really honored to be here. Thank you.
Thank you. We'll have you back. Ahmed Saeed, Vice President of Operations from the Asian Development Bank, and we'll be back right after this break.
Great. Thank you.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com.
Back on the HPS Insight Macrocast, Tony Fratto, John Fagan, Brendan Walsh. Great having Ahmed in here for his global perspective. We have to see if we can get him back whenever he's in town. We talked a little bit about China trade and its impact. We had we got the mini deal, the micro deal, the skinny deal. Use your
micro mini
adjective of choice. But
$50 billion.
We think of maybe
over some sort of time frame.
over some kind of time frame, yeah, whatever it is. So we have this little deal. Let's talk about the components of it. Actually, do we have a deal? Because there is no paper on it. There's just tweets about it and some commentary here and there. So what do we think the components are? What still needs to get done?
As we discussed last week, getting into this brass tacks negotiation at the end of last week, the contours of the deal seemed pretty clear. It was going to be the U.S. putting the tariff increases on October 15th and December 15th on the table, and the Chinese coming with enhanced purchases of U.S. farm goods from their side. There was some question as to whether the parameters might include another temporary extension of waivers for U.S. companies to sell non-sensitive stuff to Huawei, the Chinese IT giant, with sort of security and other concerns attached to it that's on the blacklist.
Yeah.
There was some potential for some other ancillary kinds of accord extra agreements that might get thrown into the mix, but really the when they announced it, the contours of it were about as narrow as one could have expected. The Chinese signed up or put their hand up for increased. It's $50 billion, as Brendan mentioned, $50 billion, 40 to 50 billion,
40 to 50 billion,
legging into it over a 2-year time span. And the U.S. took the October 15th tariff increases off the table. Treasury Secretary Mnuchin suggested that there was some meeting of the minds. There was some terminology that was going to be in there on the currency side about currency transparency. It's not clear what that's going to be.
Do you expect it to be anything but the agreement they announced in February? They announced that Mnuchin announced what he said was the strongest currency agreement ever negotiated, but wouldn't say what it was. And so the expectation was, well, it will be in this at that time, expected trade agreement, which never came. So now it's going to be dropped into this one, but we still don't know exactly what it is. And it seems to be from the Chinese side, at least their language, is that they still, they're going to do what they need to do for their domestic economy, and they're not going to manipulate the RMB to gain an unfair trade advantage, which is that's the language of art around currency and at the IMF and in our monetary policy and currency policy regulations as well.
Right. It would be very hard to believe that the Chinese would sign on to something that would dramatically change the way that they manage the renminbi. They have stabilization measures in place around the renminbi already, and increasing transparency on it. I'm sure that there's going to be some sort of language that allows both parties to shake hands and agree on it. Secretary Mnuchin said that they hadn't withdrawn the designation that they put on in August of China as a currency manipulator. The Treasury did that in an ad hoc fashion. It wasn't part of the traditional biannual FX report, current foreign exchange report that the Treasury puts out.
When does that come out next?
It's due.
Well, it's supposed to be October 15th, but it's a moving target, and the likelihood is it's going to get delayed until after the ink is put on this mini deal, which is basically tabbed for the APEC summit in Chile, November 16th to 17th, when Presidents Trump and Xi are meeting face to face.
And so that's the time when we will know. We'll have a good sense of whether the December 15th tariffs will be in place. Secretary Mnuchin laid out that they could go in. They could be put on December 15th if there isn't an agreement. If there isn't an agreement by November 16th, 17th in Chile, then it's hard to see how
it kind of seems. I get the sense that both sides realize that. So the December 15th tariffs are on consumer goods,
right?
Which I think both sides realize this is really bad for both of us. So it's pretty stupid to do it, but you have to have a face-saving way to back away from them.
I think withholding that from the initial the initial mini deal and keeping that as the final, that's the closer that they pull in out of the bullpen, if they really need it.
Right.
And I think that shows
which makes sense. The Chinese backed away the last time. We thought the deal was done, 3 months ago. And so it does kind of make sense to hold that out, but no one wants to do it.
And I think it speaks to the fact that the White House appears to be intent on making this deal. They've made very constructive sounds around it. The Chinese have come out. The foreign ministry spokesperson came out and said that we have a meeting of the minds on this. We're united in our. There's a lot of
the
good
president
atmosphere.
keeps saying it just needs to be papered.
Right, and that is apparently going to be ongoing over the next couple of weeks. At the beginning of this week, there were a little bit of heart palpitations over the Hong Kong situation. The idea that Congress is now passing legislation in support. It's made its way through the House. It's passed the House, and it's getting up into the Senate now. This support of Hong Kong democracy and the protests there. The Chinese obviously came out strongly against this legislation and said that they would retaliate, but they didn't say how they would retaliate. It's cast a shadow for about a day
Chinese,
over the deal.
Obviously, Hong Kong is incredibly sensitive to them, and that's not going to change. The legislation, I think, it's not as doesn't have the teeth that earlier drafts of the legislation did. I expect that will be held in the Senate until after events in November for a couple different reasons. One is that to not be disruptive on the negotiations on phase one. Also, just mechanically in the Senate, they're kind of running out of time to put things on the floor.
That's a great point.
Move legislation. They're going to have to do impeachment. They're going to have an impeachment trial.
Well, no, I think that's an important, and I wanted to ask you. So this administration has kind of been a one issue. They can kind of focus on one big thing. So we can look at the details of the trade and that. But if you kind of take a step back, so Trump is going to run for president, and he has to deal with this impeachment. Mm-hmm. How much do you think that affects his willingness to just cut a deal and move on with China?
I think my base case on phase one is that it's going to get done.
Yep.
Right. I don't see. I mean, yes, anything can change, and we have seen things change pretty quickly. But I think both sides really just want to get this behind us. I think what they're going to try to do over the next period of time is try to see how much more they can cram into phase one. Mm-hmm. You heard, and we have heard people in the administration, the president say something about phase three and whatever. I do think the negotiations on a continued, formalizing the trade relationship between the United States and China will go on forever.
Right.
In the same way, the formalization of our trade relationship with Europe goes on forever, and
especially under IP, intellectual property.
Right.
I mean, we're going to be battling that for the next 20 years.
Right? I mean, we have Airbus tariffs going into place today. French wine, et cetera, is all more expensive.
Was it Irish whiskey?
Irish whiskey.
Yeah, I'm very upset about
cheese that. So the IMF World Bank receptions just got more expensive, a lot more, 25% more expensive. Yeah. So but my point is that we have a long, mature, very positive trade relationship with Europe, and we still have these kinds of things. So it's going to happen for a long time. So I don't know about phases. But that said, I don't see a phase two with the United States and China in this administration. So, I think that's...
Because phase one is the easy stuff.
Yeah.
They're just throwing it in, then he can run. Phase 2 or 3 or 4 is the real stuff.
Yeah, I agree.
And I don't see any solution to that.
Let's take a quick break. When we get back, I want to talk about Brexit and corporate earnings, and then see what we have coming up next week. You're listening to the HPS Insight Macrocast.
Hamilton Place Strategies is an analytical public affairs firm based in Washington, D.C. Learn more at hamiltonplacestrategies.com or follow us on Twitter at HPS Insight.
All right, we're back with the Macrocast. John, it looks like, against all odds, Bojo maybe has an agreement with Europeans on Brexit. Where does that stand this morning?
This was quite a dramatic turn of events. We had only a a few weeks ago, there was a sense that the deal was impossible. Prime Minister Johnson had reportedly received a stern dressing down on the phone by German Chancellor Merkel that was apparently so ill-humored that it got UK government officials characterizing a deal as impossible. And from the ashes of that moment, Prime Minister Bojo managed to put something together, and events moved very quickly after his meeting with his Irish counterpart. The concessions that he was willing to make on the Irish issue, the Irish border issue, the furious negotiations which yielded a draft deal against expectations that was ready for review by the European Leaders Summit at European Leaders Summit yesterday. The expectation was that would probably be not a difficult endorsement to get, and that was proven out by events. The EU leaders endorsed it, and that set up the big showdown in Parliament. Parliament is where his predecessor's deal died 3 times. Roundly defeated Prime Minister May's draft Brexit deal in Parliament.
Embarrassing fashion.
Yes, historic faceplant level failures. Yeah. But the numbers this time, there's some sense that perhaps this time, despite the fact that the Conservative Party's Northern Ireland allies are all set to vote against it, they're going to take their 10 votes and vote against it, that he may possibly have the numbers. Now, we're getting headlines today that this vote may not happen. Yeah. The Conservative Party rebellion might push it off. There is legislation passed by Parliament while Prime Minister Johnson was at the G20 seeking to compel him to request a 3-month delay if he does not have a Brexit deal finalized by tomorrow. So this is all quite an exciting.
Yeah, it's still pretty. I think still
moment.
Pretty fluid. I mean, although I would say, if we were judging by how currency traders are judging the situation and assuming they have some knowledge, they're optimistic, right? Sterling has rallied.
Yes, the pound's at a 5-month high, but even where it's now, this is coming from the lowest level, the depths of really. It's still down from the pre-Brexit level. It's down 17%. This is still a very weak level for the pound overall. We've seen this bounce basically be attributed to taking the worst case scenario of a disorderly Brexit, at least shaving those odds down and having a reasonable path to an orderly exit. But even if he wins, even if Boris Johnson carries the day and he's able to get enough votes for his deal and it goes through on Saturday, winning the who wants to make a Brexit deal? Tell him what he won. He won an increasingly hollowing out economy, and
there's actually headlines coming across now that Peter Kyle, who's in the opposition, is proposing a second referendum on Brexit.
Yeah, and a divided electorate, and the possibility of a accelerated general election, and even if he's able to carry the day tomorrow, which is very, very chancy tenuous odds, tenuous odds. It's hardly a scenario. Even an orderly Brexit isn't something that puts the pound on a rocket ship to the moon and retraces all of its to its pre-Brexit vote level.
That's an important point.
This is still, this obviously it would be taking the worst case scenario off the table. If he does. Prime Minister Johnson has said that he would defy Parliament and not ask for an extension. And this is partially because if he does, then in his estimation, they may never leave at all.
I suppose that exposes him to. My British parliamentary knowledge is, despite how much we've learned over the past 3 years. Can he be exposed to a no confidence vote, or is he immune from one for a while? The only thing he could do is a general election at this point, right? I think.
Well, I think the Labour Party leadership, Corbyn, and the other Labour Party leadership have prioritized a Brexit delay or an orderly Brexit ahead of a push to a general election. And with his depleted he doesn't have a majority.
Right.
His depleted supporters and the divided Conservative Party, it is easy to imagine how the Labour Party might be able to bring the government down after a failed vote tomorrow.
So by leaving they would just have to leave the coalition, or withdraw its support.
Yeah, I think that's right, and that's another headwind on the pound. But as we said last week, this is not translating into systemic stress indicators rising in the UK. Things like credit default swaps or real pressure on the sovereign debt or something like that. This is a cyclical rather than a structural type of adverse consequence.
Let's take just a couple of minutes on some other maybe cyclical or structural. What are U.S. corporations facing? We're the early stages of earnings. We started getting some this past week. So it's earnings.
Yeah, it's been busy, and especially with the financials. So about 83% of companies that have reported have beaten. But the big ones is the banks have reported, and especially when you look at both the net interest margin came in a little better. So with the lower rates, the banks are kind of surviving. It's down, but not disaster.
Yeah.
But most importantly, in terms of credit, we're not seeing any pickup in defaults or delinquencies. Jamie Dimon is he's the CEO of JP Morgan, and his commentary is always very much followed by both the market and also the broader public. He was a little more cautious on the global economy, especially because of the trade.
Yeah.
So while his company's doing well, he does see some dark clouds on the horizon, but not calling for the end of the
and
world.
all the other banks seem to have been.
Especially Morgan Stanley was a very, very strong earnings yesterday. American Express today was quite good. And then you also had, John, maybe talk about the rail guys. You kind of follow those relatively closely.
Yeah, just very quickly, the rail giant CSX last earnings season was one of the wet blankets on of the announcements.
Feeding into the sort of view that a slowdown, if transports or if they're not moving stuff around, then maybe people aren't shipping, and they're shipping it because people aren't buying it.
Right, and after the bad quarter, the expectations came down, and they announced results that really bore out a lot of the challenges that they're still facing. But over the course of the quarter, expectations had gotten so far down that they were able to leap over these diminished expectations. And so this was a quarter where earnings were supposed to be pretty weak, and that has afforded a lot of the companies that have reported so far, sort of an easier benchmark to beat.
Beats are good. I like the beats.
Yeah, but it supported the equity market as a whole. I think today the market is expecting a trade deal.
Yeah.
So the market, for the most part, was up this week, much more on earnings rather than kind of the macro headline tweets.
What do we have to look for next week?
So market produces a bunch of global PMIs, which are
MARKIT.
MARKIT, yeah. So and they have the same. The survey is the same across countries, so you can kind of compare them. We get ones in Japan, we get ones in Europe, Germany. And then we get the U.S. So that'll give us a good sense of both how the global economy is doing, but also, as we talked about, how the trade war is affecting the world as a whole.
And sensitivity is running high after the GDP number that Tony alluded to earlier out of China. There is definitely heightened sensitivity to global growth downside, and we've heard a lot of that around the meetings this week.
Yeah, I heard it this morning as well. I was at a breakfast with the German finance minister expressing some of the same.
Oh, interesting. Yeah. And then the other big, it shouldn't be a big event, but it's a farewell for Mario Draghi, his last ECB meeting. So they kind of shot the bazooka last week. Last meeting, they cut the rates and they did the quantitative easing. But on November 1st, we will get a new president. And actually, is she at the IMF meetings? No, she's left, right?
No, she's left. She's gone. So this is the first time in a long time we haven't had Christine Lagarde here at the IMF World Bank meetings. But yeah, she'll be starting in November.
Yeah, the end of an era, and we've tipped our cap to Mario Draghi's masterful performances over the years before. But it's very impressive. And now, of course, the hawks on the committee are taking this opportunity to rattle the cage.
It's important. Maybe we can talk about it next week. But she's walking into a very divided ECB, and I think the hawks are looking at that as a chance to kind of pounce on her. So it'll be very interesting to see how she does. But
why don't we?
I have faith in her.
Yeah. Why don't we make that a point next week of looking forward to the things that she has to deal with as the incoming new ECB president. Okay. John Fagan, Brendan Walsh with Markets Policy Partners. Great talk this week. I want to thank our guest, Ahmed Saeed, Vice President of Operations from the Asian Development Bank. I'm Tony Fratto. We'll talk to you next Friday. Have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.